You've heard me name the OAS recovery threshold before. Today, we are staying inside the indexed numbers. The full mechanics of how that 15-cent recovery tax actually computes, the CRA, the Canada Revenue Agency, calls it a recovery tax, which is generous phrasing for a 15-cent haircut on every dollar above the line. They are recovering it from you. Every month you wait on managing your Line 23-400 income costs you roughly $112 in OAS recovery tax. By the end of this video, the meter will have run $1,350. Quick note, if your retirement income is below $90,000, you are not paying this tax this year. But knowing how it scales matters before it does. If you are deferring OAS, Old Age Security, the federal pension that starts at 65 out to 70, the recovery still applies once your checks start. And if your income is closer to $60,000, your test is GIS, the Guaranteed Income Supplement, a separate lower income program, not this one, different program. 3 loops. 1. When this hits your check. 2. Which line triggers it. 3. How one retiree pays $1,350 while another with the same income pays 0. We walk through this in 4 moves. The line on your tax return sets the table. How the recovery actually hits your OAS check and when is the math everyone gets wrong. Where the lag puts your real exposure is the move that fixes it. And what 2 moves drop the tax to 0 on the same starting income is the trap to watch for after. Start with the line itself. The line is the part most explainers get wrong. Line 23-400, which is net income before adjustments, is the figure the CRA tests against the threshold, not line 23-600, which is net income after adjustments. That distinction matters because some planning moves change line 23-600 without touching the line that actually decides the tax. Now the rate. 15 cents on every dollar of line 23-400 above the threshold. We are in a transition window right now. If you are looking at checks between now and June 2026, the threshold is based on your 2024 return, $90,997. Starting July 2026, the CRA pivots to the 2025 return you filed in April, bumping the safety zone to $93,454. Project your July reduction with the wrong threshold, and your math is off. The rate does not move. The threshold moves with inflation, and the pivot happens every July. The statute is Income Tax Act Section 180.2, which defines the 15-cent recovery tax and authorizes the CRA to take it at source. A few boundary lines. The recovery tax is federal only. No provincial overlay, no combined rate. Non-residents file under the OAS return of income, and the recovery rate can shift under tax treaty. That is an accountant question, not a YouTube one. Deferring OAS to 70 does not exempt you. Deferral grows the check by 0.6% for every month you wait, but a larger check just means more OAS sitting on the table, available to be recovered if your line 23-400 crosses the threshold. So anchor the test before any planning move. The line is 23-400. The rate is 15 cents. The threshold is what the CRA publishes every year. That is the formula. 15 cents on every dollar over $90,997 applied to line 23-400, not 23-600. The formula is the easy part. What trips most retirees is when it actually hits their check. And the answer is not the month they thought. The recovery tax keys to your prior tax year line 23-400 and bleeds out across the July to June payment year that follows your filing. CRA filing statistics show that the recovery for the 2024 tax year, filed by April 30th, 2025, sets the per-check reduction on every OAS payment from July 2025 through June 2026, 12 checks, divided by 12, pulled at source. So the recovery bleeding out of your July check is keyed to a return you filed 3 months earlier, against income you earned 6 months before that. The system runs on a delay only an accountant could love. The relief valve. If you expect your current year income to drop significantly below the prior year, you can file Form T1213 OAS, the advance reduction request that asks the CRA to lower the at-source deduction on your OAS checks. Typical processing is 8 to 10 weeks, longer right after tax season when backlog peaks. The reduction applies to checks going forward only, not retroactively to checks already issued. Edge cases worth flagging. If a spouse dies and you inherit their RRIF, the Registered Retirement Income Fund, that RRSP balances convert to at 71, your line 23400 can jump above the threshold for the first time. A one-time capital gains event, the sale of a cottage or a small business, is the textbook T1213 OAS case. And the GIS lower income test is a separate program for retirees closer to 60,000. So the recovery your July 2025 check is paying for is keyed to income you booked the prior tax year, a 12-month bleed against a snapshot 3 months stale. Knowing the formula and the lag still leaves one number unanswered, the number for you. Here is the third piece, what the recovery actually costs a real retiree. Meet Margaret, 68, Ontario, retired school teacher. Her defined benefit pension, DB, the pension her employer pays on a formula tied to years of service, runs $58,000 a year. She draws $32,000 from her RRIF, which she chose to convert early from her RRSP, her Registered Retirement Savings Plan, and $10,000 of other taxable income rounds her out. Her line 23400 for 2024 is $100,000. The CRA's most recent notice confirms the maximum recovery ceiling for her age band, 65 to 74, sits at $148,451. For the 75-plus band, it is $154,196 because the age 75 supplement adds more OAS to recover. Margaret is inside her ceiling, so she pays the partial recovery. Run the math. 100,000 minus 90,000, 997 leaves 9,003 of excess. Multiply that by 15 cents. Her annual recovery tax lands at $1,350.45. Now the surprise. The CRA does not send her a bill in April. They divide by 12 and pull from each OAS check from July through June. Her check drops from $742.31 to $629.77, $112.54 a month until next July. She does not feel it as a tax. She feels it as a smaller check. David has the same income, same accounts, same age. The only difference is 2 decisions he made before he filed, and the fourth piece is how those 2 moves drop the tax to 0. His spouse, Susan, is 66. Her income, OAS, and a small CPP sits well below the threshold. That gap is the lever. Move 1 is pension splitting via Form T1032, the joint election a couple files to split eligible pension income. Eligibility is tight. RRIF withdrawals, defined benefit pension, and eligible annuities qualify after 65. Raw RRSP withdrawals do not qualify until converted to a RRIF. David is drawing RRIF income at 68, so they qualify. Move 2 is TFSA first sequencing. TFSA, the tax-free savings account. TFSA withdrawals do not land on line 23400, so swapping a TFSA draw for a RRIF draw pulls income off the line without changing what David spends. Requires an existing TFSA balance. The order matters. He swaps $5,000 of his $32,000 RRIF draw for TFSA. That drops his eligible RRIF pool to $27,000. He then attributes the 50% maximum, $13,500 to Susan. She reports it on her line $11,600. David takes the deduction on line $21,000. David's line $23,400 drops from $100,000 down to $81,500. That is below the threshold. Annual recovery tax, $0. This maneuver works perfectly, but only if you verify that Susan has enough runway below her own $90,000 threshold to absorb the cash without triggering a clawback of her own. At his new $81,500 bracket, his Ontario marginal rate on the $5,000 also drops roughly 9 points versus leaving it inside the RRIF. One more lever, the spousal RRIF attribution rule. Income Tax Act Section 146.3, sub 5.1. It pulls above minimum withdrawals back to the contributor's income inside a 3-year window if a spousal contribution was made. Not walked here. David's recovery tax is 0. Same starting income, 2 moves. That is the toolkit. The toolkit is built around one constraint: liquidity that does not force an excess RRIF withdrawal on top of your mandatory minimum in a year managing line 23,400. If the number on that screen surprised you, the like button is what tells YouTube to put this in front of the next Canadian about to walk into it. David's moves work because he had options: a Susan to split to, a TFSA balance to substitute from. Most retirees who get blindsided by the recovery tax got blindsided because their only liquidity was an RRIF withdrawal. Need a new roof? Draw from the RRIF. Need to cover a tax installment? Draw again. Every one of those draws lands on line 23,400, and every dollar above the threshold gets the 15-cent haircut. Cash held outside a registered account does not have that problem. Withdrawing your own cash is not income. The principal does not appear on line 23,400 when you take it out, because it was already taxed before it went in. The dollars that built that balance were on your line 23,400 the year you earned them. They do not come back the year you spend them. 2 honest caveats. First, the interest cash earns is taxable and does hit line 23,400. Cash is not a tax shelter. Second, the RRIF minimum itself, the CRA set percentage you must withdraw every year from 71 on, you cannot skip. Cash does not let you avoid the minimum. It is a holding place for discretionary spending you do not want forced through an RRIF draw on top of that minimum. This is where WealthSimple Cash fits. A high-interest cash account that holds dollars a retiree might otherwise have to pull as an extra RRIF draw on top of the minimum. Linked below. Whether the math works for your needs is your call. If your prior year line 23,400 spiked from a one-time event, but your income this year will be lower, the lever you have left is Form T1213 OAS. File it to reduce the deduction at source. The CRA typically takes 8 to 10 weeks, longer after tax season. When approved, they issue a letter of authority and instruct Service Canada to lower your future check deductions. Most of these mistakes get fixed in a single decision. Once you know they exist, subscribe so the next one shows up before the cost does. Next, TFSA versus RRSP, the banker's secret mistake. That is the wrapper choice sitting upstream of this whole calculation, the choice that decides whether you ever cross the threshold we just walked. Everything in here is information, not personal advice. Take it to someone who can see your full picture before you act. Thanks for watching.